Welcome to the Explainer. If you're diving into CFA Level 2, you already know the quant section is a whole different ballgame. We're moving beyond just describing what happened in the past and into building models that can actually predict the future. So let's get right into it and upgrade your analytical toolkit.
So everything really starts with this one big question: what truly drives a stock's return? Now, back in Level 1, the answer was pretty simple: the market. But let's be real, in the actual world of investing, it is never, ever that simple. Is it the market? Is it the company's size? Its growth prospects? We need a tool that can juggle all these different factors at the exact same time.
And yeah, Level 1 gave us simple linear regression, which was a great starting point. But honestly, it's like trying to navigate a huge complex city with a compass that only points north. The real world has inputs coming from every direction, and if you're only looking at one, you're going to get blindsided.
So this is where Level 2 really steps up. It gives us the tools to move beyond that single, simple explanation and build a framework that can actually handle the beautiful messiness of financial markets.
And here it is, our shiny new tool, multiple linear regression. Now, don't let the equation freak you out. All it's saying is that we can explain our main variable, let's call it y, like a stock's return, by looking at the combined impact of a bunch of other variables, all our x's, at the same time. This thing is the absolute workhorse of quantitative finance.
Okay, so how do we actually read the results? Let's look at this output here. We're trying to explain a company's return on assets, or ROA. Now look at the coefficient for CapEx, that's capital expenditures. It's 1.2495. So what does that mean? It tells us that for every $1 increase in CapEx, we expect ROA to go up by about 1.25 units. And here's the key part. That's assuming all the other factors in our model are held perfectly still. See? We're isolating the impact of each individual driver.
All right, this next part is a huge Level 2 distinction. Back in Level 1, we all loved R squared, but it's got a fatal flaw. It pretty much always goes up when you add more variables, even if they're completely useless, and that is a classic exam trap. So we upgrade to adjusted R squared. It's smarter. It actually penalizes the model for adding junk variables that don't help explain anything. And here's the exam tip. It will only go up if the new variable's absolute t-stat is greater than 1. Remember that.
You know, building the model is really just step 1. A real analyst knows how to diagnose it when it's sick, because even the best-looking models can be built on a shaky foundation, and that can lead you to some seriously wrong conclusions.
And here are the 3 usual suspects you absolutely have to know for the exam. First, you've got conditional heteroscedasticity. Just think of that as the model's error being unpredictable. Then there's multicollinearity. That's when your inputs are all tangled up and telling you the same story. And finally, serial correlation, which is when your model's mistakes have a memory. They shouldn't.
Let's just zoom in on heteroscedasticity for a second. Why should you care? Because it messes up your standard errors, which in turn makes your t-statistics totally unreliable. What usually happens is they get inflated, making you think a variable is a big deal when it's really not. This is a huge flaw. It can trick you into making a type 1 error, basically seeing a relationship that isn't really there. You're seeing ghosts in the data.
Okay, you're going to want to remember this table. It's your diagnostic cheat sheet. If you've left out an important variable, you'll see weird patterns in your error plots when there should just be random noise. For multicollinearity, we check something called the variance inflation factor, or VIF. A high VIF, say over 5 or 10, is a red flag that your variables are redundant. And for serial correlation, we use the Bruce-Godfrey test. A significant result tells you your model's errors are predictable, and that's a problem. Mastering this is key.
So, up until now, all of our models have been like a snapshot in time. But finance is always moving, right? So when we start analyzing data over time, we step into a whole new world, time series analysis, and it has its own set of rules. The single most important concept in this entire area is covariance stationarity. All this means is that a time series has properties, like its average and its volatility, that don't change over time. Think about it. A stock price that's trending up and up and up is not stationary. Its mean is obviously changing. If you run a regression on non-stationary data, you can get results that look amazing but are actually complete and utter nonsense.
So, the simplest time series model is called an autoregressive model, or AR for short. And an AR1 model is incredibly intuitive. The logic is simple. The best predictor of something's value tomorrow is its value today. That's it. We're just regressing the data on a time-lagged version of itself. So our forecast for tomorrow is just the model's coefficients multiplied by today's value. Simple as that.
And this simple model connects us to a really powerful idea in finance, mean reversion. It's the theory that things like interest rates or profit margins tend to snap back to some long-run average. Well, our AR1 model gives us a precise formula to calculate that average level. If the value today is way above that level, the model predicts it will fall. If it's below, the model predicts it will rise. See how the stats connect right back to a financial idea?
Okay, time to take the final leap. Traditional regression is amazing, but it has a big assumption that relationships are linear. They're straight lines. But what happens when reality is a lot more complicated? Well, for that, we turn to machine learning.
This is really the core question that machine learning tries to solve. What if a factor's impact changes depending on other conditions? What if there are complex interactions that aren't just simple addition? These kinds of nonlinear relationships are everywhere in finance, and our standard linear models will miss them every single time.
One of the main branches here is called supervised learning. It's called supervised because we kind of act like a teacher for the algorithm. We give it a ton of training data where we already know the right answers, and its job is to figure out the hidden pattern that connects the inputs to the outputs. Find the pattern, then apply the pattern. That's the core idea.
A perfect example of this is a decision tree. It works just like a game of 20 questions. It starts with all of your data and asks a simple yes or no question. Something like, is the price-to-sales ratio less than 1.075? Then it splits the data into two piles, a yes pile and a no pile. And it just keeps doing that over and over until it gets down to a final answer. It's a really intuitive way to map out complex decisions.
But with all this power comes a really big challenge, the bias-variance trade-off. An overfitted model has high variance. It's like a student who just memorized the answers to the practice exam. They'll ace the practice test, but they'll bomb the real thing because they learned the noise, not the actual concepts. On the flip side, an underfitted model has high bias. That's the student who didn't study at all. Their model is way too simple and fails everywhere. The whole game is finding that perfect sweet spot in the middle.
All right, let's pull all of this together and take a look at the brand new, seriously upgraded quantitative toolkit you've built for Level 2. You can see the clear journey we've been on, right? We started by seeing the limits of simple models. Then we built powerful multiple regression models. Then, crucially, we learned how to play doctor and diagnose their problems. After that, we added the dimension of time. And finally, we peeked over the horizon at the world of machine learning. It's a logical progression. So yeah, you can really boil it down to these 5 core areas: using multiple regression, diagnosing your model's flaws, handling time series data, leveraging machine learning, and properly evaluating your results. This is the modern analyst toolkit. This is the whole shebang.
And that brings us to what I think is the most important takeaway of all. Level 2 Quant is not about memorizing formulas anymore. It's a complete mindset shift. It's about learning to think like a true analyst, to build a model to answer a question, to be skeptical and stress test it, and then to interpret what it's really telling you about the world.
Which leaves us with one final big question to think about. We're building these incredibly smart, powerful tools that can see patterns we could never spot on our own. But as our models get more and more sophisticated,
What does that mean for us? What's the new role for human judgment and intuition? That's a question every single future charter holder is going to have to answer.
All right, welcome everyone. If you're diving into CFA Level 2, you know just how crucial currency movements are. So today, we're going to crack the code on something called the international parity conditions. Think of these as the fundamental rules of the road that connect exchange rates, interest rates, and inflation. They're basically the bedrock of global asset pricing. Ready? Let's jump in.
So why kick things off with a quote from Alan Greenspan? Well, there's a really good reason. This is a masterclass in humility, and honestly, it's a huge lesson for anyone in the investment world. What he's telling us, loud and clear, is that trying to guess where a currency is going tomorrow, or even in the next hour, is a fool's game. Seriously, if the chair of the Fed admits he can't do it, what does that tell you?
Okay, so if we're not predicting, what are we doing? We're focusing on understanding the deep fundamentals. Here's how we'll break it down. First, why forecasting is futile. Then we'll hit purchasing power parity, connect that to interest rates, weave it all together into what we'll call a web of parity, and finally, we'll look at the famous carry trade, a bet that these rules will actually break.
All right, Section 1, the futility of forecasting. Here's the thing you have to get your head around. In the short term, exchange rates basically follow what we call a random walk. It's like a coin flip. You just can't predict the next move. But, and this is a big but, it's not total chaos. Underneath all that daily noise, there are these huge, powerful economic forces that act like an anchor, slowly but surely pulling currencies back towards some kind of long-run fair value.
So, what does this mean for you? It means your job isn't to be a day trader guessing the next tick. Your job is to be a strategist. It's all about understanding these long-run anchors. Why? Because that's what helps you figure out if a currency is fundamentally cheap or expensive. And that, my friends, is absolutely critical when you're managing a global portfolio or trying to hedge your currency risk effectively. Okay, let's grab onto our first anchor. This one's called purchasing power parity, or PPP for short. Out of all the parity conditions, this is probably the one that just makes the most sense intuitively. It's a super direct link between the changing value of your money, which is just inflation, right? And the price of that money on the global stage, which is the exchange rate. The whole idea of PPP boils down to something really simple called the law of one price. I mean, think about it. A bushel of wheat is a bushel of wheat, right? So it should cost the same in New York as it does in Toronto once you convert the currency. If it doesn't, well, you'd have armies of traders buying it cheap in one place and instantly selling it for a profit in the other. That's arbitrage, and they do it until the prices snap back into line. Now, there are two flavors of PPP you need to know about. There's absolute PPP, which says the level of exchange rates should reflect price levels. Honestly, that one almost never holds true in the real world because of things like shipping costs, taxes, all that stuff. So for our purposes, and definitely for the exam, we focus on relative PPP. This is the one that matters. It says the change in the exchange rate should be all about the difference in inflation rates. So if one country has 5% inflation and another has 2%, you'd expect their currency to move by about 3% to balance things out. It's a really powerful valuation tool. And this is a huge takeaway, maybe one of the most important points for the exam. If you try to test this theory over a single year, the data is just a total mess. The relationship looks like it doesn't exist. But if you stretch your timeline out to 5, 10, even 15 years, wow, suddenly this beautiful, clear relationship pops out of the data. So what's the bottom line? PPP is useless for short-term trading. It is everything for long-term valuation.
All right, so we've got the inflation exchange rate link nailed down with PPP. Now let's add the next massive piece of the puzzle, interest rates. We're shifting gears now, moving from the world of goods, wheat and cars, to the world of capital. And this is where things get really, really interesting for us as finance pros.
What you're looking at here is the logic behind covered interest rate parity. This isn't a loosey-goosey economic theory. This is a hard and fast rule enforced by risk-free arbitrage. I mean, just imagine for a second you could follow these steps and make a guaranteed profit with no risk. What would happen? Traders would throw billions of dollars at it in a nanosecond, and that free lunch would disappear. That's why the forward exchange rate isn't a guess or a forecast. It's a calculated price, baked in by a formula you absolutely have to know. The forward premium or discount you see in the market exists for one reason: to perfectly cancel out the interest rate difference between two countries. No free money here.
Okay, now for the fun part. What happens if we take away the safety net? What if we ditch that forward contract? Well, then we get uncovered interest rate parity. Think of it as the daredevil cousin of covered IRP. This one says that the future spot rate itself is expected to move to offset the interest rate difference. It's not about a locked-in price anymore, it's about expectations. And this is key, it's not an arbitrage rule. It's an economic theory, and it relies on a pretty big assumption that investors don't care about risk.
So let's connect some dots here. We know covered IRP has to hold. It's a law of finance, basically. Now, if you also believe that uncovered IRP holds, then you're led to a really powerful conclusion. It's called forward rate parity. And all it says is that the forward rate that you can see quoted in the market right now is the best possible unbiased forecast of where the spot rate is going to be in the future. The billion-dollar question, of course, is, does uncovered IRP actually hold up in the real world?
Okay, so we've looked at these different pieces: PPP, covered IRP, uncovered IRP, kind of one by one. But the real aha moment, the real magic, is when you see how they all lock together. This is where we're going to build the whole web and see how everything connects in one big, beautiful framework.
This table is your map. It lays out the entire system. Let's just trace the connections, right? You see the inflation difference at the top? That connects to the expected change in the spot rate through our old friend PPP. Now look at the interest rate difference. It has two paths. It links to the forward rate through the no arbitrage logic of covered IRP, but it also links to the expected spot rate through the risk-neutral world of uncovered IRP. And to tie it all up, the International Fisher effect connects inflation and interest rates directly. See? It's a totally interlocking system. Every piece affects every other piece.
So we've built this elegant, logical web of theories where everything balances out perfectly. Beautiful, right? But what happens when one of those links snaps? That's where theory crashes into reality, and it gives rise to one of the most popular and one of the most dangerous trading strategies on the planet. Let's talk about the carry trade.
So, what is the carry trade really? At its core, it's a direct bet against uncovered interest rate parity. Simple as that. Remember how uncovered IRP predicted that the currency with a high interest rate would fall in value to cancel out that extra yield? Well, the carry trader is betting that's just not going to happen. So they do the obvious thing. They borrow money in a currency with super low rates, like the Japanese yen for years, and they invest it all in a currency with high rates, like the Aussie dollar. And then they just sit back and hope to collect that juicy interest rate spread.
And this right here shows you the classic risk profile of the carry trade. You've probably heard the saying, it's like picking up nickels in front of a steamroller. And that's exactly right. The reward, the nickels, is that slow, steady drip, drip, drip of income from the interest rate difference. But the risk, that's the steamroller. It's sudden, it's catastrophic crash risk. A single, sharp, unexpected move in the exchange rate can literally wipe out years of those hard-earned nickels in a matter of hours.
And you might ask, why does this happen? Well, it's because the trade works great as long as markets are quiet and happy. But the moment things get scary, the moment turbulence hits, what does everyone do? They all try to get out the door at the exact same time. It's a stampede. This flight to quality means everyone is desperately selling that high-yield currency and scrambling to buy back the safe, low-yield one they borrowed in. And that rush for the exit door is what causes the very crash they were afraid of. It's a brutal, self-fulfilling prophecy.
Okay, let's pull it all together. What are the key takeaways here? First, the international parity conditions are not your crystal ball for short-term trading. Forget about it. What they are is the fundamental architecture,
the building blocks that connect inflation, interest rates, and exchange rates into one big logical system. They are the anchor you need for long-term valuation and for smart risk management, even when they tell you nothing about what's going to happen tomorrow.
So I'll leave you with this one final thought to chew on. We've spent this whole time talking about these parity conditions as a long-run anchor, which is true. But it begs a really important question for any of us investing in today's wild, volatile markets. Just how long is the long run, anyway? And in a world that seems to be getting crazier by the day, how much weight can any anchor truly hold? All right, welcome CFA Level 2 candidates. In this explainer, we are diving deep into a couple of core topics in financial statement analysis. First, we're going to tackle how companies account for their investments in other companies. Then we'll pivot to the absolutely crucial skill of figuring out if a company's earnings are for real. And believe me, this isn't just about passing the exam. This is what real-world analysis is all about. So, let's get right into it.
And this is the question, right? It's the one that should be running through your head every single time you open a financial report. The numbers are telling a story, and our job is to play detective. Is it fact or is it fiction? We have to look behind the curtain, challenge the assumptions, and figure out what's really going on. This session is all about sharpening the tools you need to do exactly that.
Exactly. If Level 1 was all about memorizing the rules, what they are, Level 2 is where we level up. It's about understanding why these rules exist, and more importantly, how the choices management makes can totally change the numbers we plug into our valuation models. This is where you really make that critical shift from thinking like a bookkeeper to thinking like a true analyst. Okay, so let's kick things off with our first scenario. Imagine a company invests in another one, but they don't buy the whole thing. They don't have total control, but they have some sway. How does that influence show up on the books? Well, that brings us straight to our first key method, the equity method.
The equity method is what we use when an investor has significant influence. That's the key word, but not outright control. For the exam, your mental shortcut should be an ownership stake somewhere between 20 and 50%. Just think of it as a spectrum, Less than 20%, it's usually just a passive investment. More than 50%, you've got control, and that's a whole other story with consolidation. The equity method sits right in that sweet spot in the middle.
So the value of this investment on the balance sheet isn't static. It's a living number. It changes based on 4 key moves. First, you start with what you paid for it, the initial cost. Easy enough. Step 2, you add your slice of the pie from the investee's net income. Now, step 3 is where people get tripped up. You subtract any dividends you receive. Think of it this way. The dividend isn't new income. It's the company giving you back a piece of your own investment. So it reduces your investment balance. And finally, you subtract any amortization from the purchase.
Let's make this real with some numbers. So, Parker buys a 30% stake in Prince for 500,000 euros. That's our starting point. Then, Prince goes and makes $100,000 in net income. Parker's share? 30% of that, so we add 30,000. Now, Prince pays out a $50,000 euro dividend. Parker gets its 30% cut, which is 15,000, and we subtract that. After a final little adjustment for amortization, bam, the year-end balance for the investment is 506,000. You can see how the investment account is now a direct reflection of how Prince is doing.
And this brings us to a classic exam curveball comparing IFRS and US GAAP. So what happens if the investment goes sour and gets impaired? Both standards say you have to write it down. But the key difference is what happens if it bounces back. Under IFRS, you're allowed to reverse that impairment loss. But under US GAAP, nope, the loss is considered permanent. Once it's gone, it's gone. This is an absolutely critical distinction you have to know for the exam. Okay, let's climb up the influence ladder. What happens when a company goes all in, buys more than 50%, and gets total control? Well, the accounting game changes completely. Once you have control, you ditch that single line item. Now you have to use the acquisition method, which means one big thing: consolidation. You're literally combining the two companies' financial statements, line by line. Their cash with your cash, their debt with your debt. The logic is simple. You control all their assets and you're on the hook for all their liabilities, so your financials have to show that one big combined economic entity.
There are 3 core ideas here you've got to nail down. First, everything the target owns and owes, their factories, their patents, their loans, it all gets revalued to its current fair market value. Second, all those hefty fees for lawyers and bankers to get the deal done, you expense them right away. You don't get to roll them into the price. And third, and this is a big one, if you pay more than what all that stuff is worth, that excess becomes an asset called goodwill.
And the way we treat goodwill today is super important. Back in the day, companies would amortize it, just chipping away at it a little bit each year. Not anymore. Today, goodwill just sits on the balance sheet. It's not amortized. Instead, at least once a year, you have to test it for impairment. This means a company's earnings could look nice and smooth for years and then suddenly get slammed with a massive impairment charge if that business they bought starts to struggle.
And here we go again, another IFRS versus US GAAP showdown that you need to know. For impairment testing, IFRS uses a pretty direct one-step approach. If what the unit is worth is less than its value on the books, you take the loss. Simple. US GAAP has traditionally been a bit more complicated, using a two-step test. These different processes can actually lead to different outcomes, which is really important when you're comparing two companies reporting under different standards.
So we've covered the rules for influence and for control. They seem pretty clear-cut, right? But here's the catch for an analyst. Knowing the rules is just the beginning. We also have to know that there's flexibility in these rules, and sometimes management can use that flexibility to paint a picture that might be a little too rosy. This brings us right to the heart and soul of financial statement analysis, assessing earnings quality. Look, the headline earnings per share number tells you how much a company earned, but our job is to figure out how they earned it, and, most critically, if those earnings are sustainable and going to turn into actual cash down the road. This definition is everything. High-quality earnings are sustainable. They come from the company's core business, the stuff they do day in and day out. Low-quality earnings? That's the tricky stuff. It's often from one-time events like selling a building, or from some accounting gimmick, or pulling sales in from the next quarter. Telling the difference between the two is honestly one of the most valuable skills an analyst has. To really bring this to life, let's look at the classic case of Sunbeam from back in the late 90s. It is a textbook cautionary tale of what can happen when a company gets desperate to show growth and starts playing games with its revenue numbers. This chart tells an incredible story. So in 1997, Sunbeam reports revenue growth of almost 19%. On the surface, that looks amazing. But then you look at the second bar. Their accounts receivable grew by over 38%, more than double the rate of sales. As soon as you see a gap like that, alarm bells should be screaming in your head. What's going on here?
What's going on is that they were getting way slower at collecting cash from their sales. Their days sales outstanding, or DSO, shot up to over 88 days. They were booking all this revenue, but the cash just wasn't coming in the door. And that is a massive classic red flag for low-quality earnings.
So the Sunbeam disaster gives us a fantastic checklist of red flags. When you see receivables growing way faster than revenue, and DSO is creeping up quarter after quarter, you have to start digging. And always read the footnotes. It turned out Sunbeam was selling its receivables to other companies to hide its collection problems and make its cash flow look better than it was.
Spotting those qualitative red flags is a vital skill. It's our analytical intuition. But we can add another, powerful layer of rigor by using quantitative tools that are designed specifically to sniff out funny business. One of the best tools out there is the Benish model. What it does is it takes a handful of financial ratios, things like DSO, gross margin, asset quality, leverage, and it crunches them all together into a single number called an M-score. And that score gives you a statistical probability that a company might be manipulating its earnings.
The model gives us a nice, clear signal. And the threshold you need to burn into your memory is negative 1.78. An M-score that is greater than this number, so less negative like negative 1.5, or even positive, that indicates a higher chance of earnings manipulation. It's not an ironclad guarantee, but it is a powerful tool that tells you it's time to start asking much, much tougher questions.
Okay, let's wrap this all up. What are the key takeaways? First, Level 2 financial statement analysis is all about moving beyond the rules and applying critical judgment. You have to master how accounting for investments shapes the story. But above all, you must always question the quality of the earnings being reported. Use those qualitative red flags we talked about and back them up with quantitative tools like the Beneish model to really get behind the numbers and find the true story.
And that's really the point, isn't it? The skills we've gone over today aren't just for passing an exam. They are the fundamental tools of your trade. Every set of financial statements you look at from this day forward is a new puzzle, a new story to investigate. So, what's the first financial story you're going to put to the test?
All right, welcome CFA Level 2 candidates. In this explainer, we are going to crack the code on corporate payout policy. Look, mastering the whole relationship between dividends and repurchases is absolutely critical for the corporate issuer section. And I promise, by the end of this, you'll have a really clear framework to ace these questions on the 2025 exam. Okay, so here's our game plan. We're going to start with the basics, the choice between dividends and repurchases. Then we'll tackle the big theory of dividend irrelevance, and more importantly, why it actually matters in the real world. From there, we'll get into the mechanics of buybacks and splits, and we'll wrap it all up with the really practical stuff, how you as an analyst analyze dividend safety. First up, let's just set the stage with a quick Level 1 refresher, shall we? When a company has a pile of extra cash, it's got two main ways to get it back to shareholders: dividends or repurchases. Now, on the surface, they might seem pretty similar, but their implications, both for the company and for your analysis, are actually worlds apart. The key difference here, the word you really need to remember, is commitment. A regular dividend creates this powerful expectation. Boards hate cutting them because it sends a terrible signal to the market. But a share repurchase? That's all about flexibility. Management can announce a huge buyback program, but they're not legally tied to finishing it. That lets them be opportunistic, timing their buybacks, or hitting the pause button if things get tight. Okay, now that we've got that foundation, let's tackle the core theory for Level 2, Miller and Modigliani's dividend irrelevance. It's a foundational concept that argues, in a perfect theoretical world, an investor's wealth isn't affected at all by how a company chooses to pay them. So the really crucial insight here is this idea of a homemade dividend. It's a neat concept. If you need cash, but the company doesn't pay a dividend, no big deal. You just sell a few shares yourself. And on the flip side, if you get a dividend you don't need, you can just turn around and use that cash to buy more shares. In this perfect little world, only the company's actual business and its investment decisions create value, not how it slices up the profits. Of course, and this is a huge of course, the theory only works if you believe in all these assumptions. And you and I both know we don't live in this perfect financial world. I mean, no taxes, no broker fees, and corporate insiders know just as much as we do. Not a chance. It's by poking holes in these assumptions that we start to see why payout policy actually matters a ton in the real world. So that begs the question, right? If the fancy theory says payouts are relevant, why are we spending so much time on it for the exam? Well, it's because in reality, these so-called imperfections are incredibly powerful forces. Let's break down the three big ones that you absolutely have to know. First and foremost, taxes. You knew this was coming. In a lot of countries, the taxman takes a bigger bite out of dividend income than he does from long-term capital gains. So this creates a really clear preference for investors who pay taxes. They'd much rather the company keep the earnings to grow the business or do share buybacks, since both of those paths lead to capital gains, which are taxed at a friendlier rate. Next up, this directly tackles that information asymmetry problem. Think about it. A press release from management is just talk. It's cheap. But a dividend increase, that's a costly signal. When a board commits to a higher payout, it's a powerful way of showing the market, hey, we are really confident about our future cash flows. And they do it precisely because they know how badly the market will punish them if they ever have to take it back. And finally, we have the issue of agency costs. The free cash flow hypothesis basically suggests that when a company is sitting on a giant pile of cash, managers might get tempted to spend it on things like pet projects or empire-building acquisitions that don't really create shareholder value. So, a commitment to pay a dividend acts like a disciplinary tool. It reduces the amount of cash just lying around, forcing managers to be a lot more careful and selective with their investments. Okay, let's shift gears from theory and get into the practical mechanics you're going to face on the exam. We need to break down two really common corporate actions, stock splits and share repurchases, and expose some of the potential traps that the exam loves to set. So here's a classic question. A company's stock price has had a great run, and they announce a 2-for-1 split. Your share count doubles. It really feels like you just made money, doesn't it? Well, let's not get ahead of ourselves. Let's look at the numbers. And this table makes it crystal clear. The answer is a big no. A stock split is purely cosmetic. It's like cutting a pizza into more slices. You have more pieces, but you don't have more pizza. You get twice the shares, but the price per share is cut in half, and so is the earnings per share. The key takeaway for the exam is that the total market value of your shares is exactly the same. And just as important, look at that PE ratio. It's unchanged. Don't fall for that trap. Okay, calculating the EPS impact of a share repurchase is a classic exam question, especially when it's funded by debt, because you have these two things fighting against each other. A lower share count, that wants to boost EPS. But the new interest expense, that wants to reduce net income, which lowers EPS. So, here are the 3 steps you follow to figure out the net effect. But you know what? There's a shortcut here, a key exam rule. It all boils down to this. A share buyback using debt will increase EPS only if the company's earnings yield, which is just EPS divided by price, the inverse of the PE ratio, is greater than its after-tax cost of debt. Think of it this way. If the return the company gets on its own shares is higher than the cost of the money it borrowed to buy them, EPS goes up. This is a must-know relationship for the exam. All right, in our final section, let's put all this into practice. As an analyst, one of your most important jobs is to figure out if a dividend is sustainable, because a surprise dividend cut can absolutely crush a stock price.
So you see a stock with a high dividend yield, maybe 5%. It looks really tempting, but a high yield can be a trap. It might be the market signaling that it's worried the dividend is going to get cut. Your job is to dig deeper and figure out if the company can actually afford to keep writing those checks.
The traditional way to look at this is the dividend coverage ratio. It's just net income divided by dividends. It's a decent starting point, but we can do way better. A much stronger metric, and the one you need to focus on for level 2, is the free cash flow to equity coverage ratio. This looks at the actual cash flow left over after all reinvestment, and it compares that against all the cash payouts, both dividends and repurchases. It tells you if the company is truly generating enough cash to back up its promises to shareholders. Now, this data right here tells a really important story. An analyst who's only looking at earnings coverage might not be too worried. I mean, it stays above 1, but the FCFE coverage, that reveals the real danger. In 2017, boom, it drops to 0.83. That is a massive red flag. It means the company is paying out more cash than it's generating from its operations. That is fundamentally unsustainable and a huge warning sign that a dividend cut could be coming. And this brings us right to the central question that you have to answer as an analyst. Is a high dividend a sign of a confident, healthy, mature company? Or is it a sign of a company that's just plain run out of good ideas for growth? Your ability to use these tools to come to a conclusion, well, that's what this is all about. Thanks for joining me, and keep up the great work with your studies.
All right, welcome back. If you're grinding through CFA Level 2, you know equity valuation is a beast. So today, we're going to crack the code on one of its absolute cornerstones, the dividend discount model. Let's get into it.
Okay, let's just start with the biggest, most fundamental question there is. What is a company really worth? I'm not talking about the stock price bouncing around every day. Forget all that market noise. What's its deep underlying value?
Well, the answer to that question is a concept called intrinsic value. And this right here is the bedrock of everything we're going to talk about. It's not the stock price. It's not what the headlines say. It's the present value of all the cash that company is ever expected to spin off in the future. That's it.
So, how do we actually start calculating this thing? Well, we're going to begin with the simplest case imaginable, which I like to call valuation in a perfect world. And that brings us to the Gordon growth model. And there it is, the famous formula. You definitely saw this back on level 1. But here in level 2, it's not just about memorizing it, it's about mastering when to use it and, more importantly, when not to. This is our go-to tool, but only for very specific companies, stable, mature ones that are going to grow their dividends at one steady rate, pretty much forever. Let's pull this apart real quick. The stuff on top, V0 and D1, that's pretty straightforward. But the real magic, the economic engine of this whole thing, is that denominator, R minus G. Think of that spread as the extra kickback you get as an investor. It's your required return after you account for the fact that the dividend is growing. The wider that spread, the healthier the situation, and the more valuable that stock is. Okay, enough with the theory. It's time to get our hands dirty. Let's plug in some real numbers for a company from the curriculum, Sunoco Products, and see exactly how this works in practice. So, it's a pretty simple 3-step dance. First, you've got to find next year's dividend, D1. You just take the current dividend and grow it by G. Easy. Second, we find that critical spread, R minus G, which here is 2.8%. And finally, you just divide the first number by the second. And boom, our model spits out an intrinsic value for Sunoco of $61.21. Now, that seemed pretty easy, right? Well, here's the catch. In the real world, how many companies actually grow at the exact same rate forever and ever? Almost none. And that brings us to the big problem with this simple model. This quote really nails the issue. A company's dividend policy is just a reflection of its investment opportunities. Look, if a company has amazing projects it can plow money into, projects that earn way more than they cost, then it should absolutely keep its earnings and reinvest them. But if it's a mature company and those super profitable projects are getting scarce, then the best thing to do is just give the cash back to shareholders as a dividend. So you end up with two totally different kinds of companies, right? You've got the young, high-flying growth company that's reinvesting every penny, probably paying 0 dividends, and growing like a weed. We call that supernormal growth. And then you have the big, stable, mature company, the one that just churns out predictable cash and pays a steady dividend. Trying to value both of these with the same simple model, it just doesn't work. And that brings us to the real puzzle you have to solve for level 2. How do you value a company that's in the middle of its life story? You know, the one that starts out as a high-growth star, but is eventually going to slow down and mature. That transition, that's everything. The answer, thankfully, is a much smarter and more flexible tool, a multi-stage model. This is what real-world analysts use to solve this exact problem for companies that are changing over time. Now, there are a few different types of these models, but a fantastic one to get your head around is the H model. What it does so well is handle a situation where a company's high growth rate doesn't just hit a brick wall one day. Instead, it assumes the growth rate declines smoothly in a straight line over a set period of time until it hits that final stable rate. It's much more realistic. So, how does this H model work? It's actually pretty clever. It splits the company's value into two distinct pieces. The first part basically calculates the company's value as if it were already a boring, mature company. You just use the Gordon growth model with the long-term stable growth rate. For this example, that foundational value is 46 euros. But wait, that's not the whole story. The company first gets to enjoy a period of that super fast growth. So the second part of the H model calculates the extra value, kind of like a bonus, that's generated during that temporary supernormal growth period. In our example, that extra growth premium is worth another 6.75 euros. And now for the easy part. You just add the two pieces together. The $46 base value plus the $675 growth premium gives us our total intrinsic value, $52.75. See how powerful that is? You're valuing both the company's stable future and the high growth journey it takes to get there. It's a much more complete picture. Okay, we have covered a ton of ground, so let's boil all of this down into your game plan. The absolute key takeaways you need to have locked in for the exam. Okay, let's nail this down. First, model selection is king. The Gordon model is only for stable, mature firms. Period. For any company that's changing or transitioning, you have to use a multi-stage model, and you better be ready to justify why you chose it. And finally, please burn this into your brain. These models are incredibly sensitive. A tiny change to your required return R or your growth rate G can make your final valuation swing wildly. The exam loves to test you on this. So now you have the tools to value a company based on its dividends. That's a huge step. But what about those exciting, disruptive, high-growth companies, the ones that pay no dividends at all? How in the world do you value them? Well, that is a fantastic question, and it's exactly what leads us to our next set of valuation models.
All right, let's jump right into one of the toughest, but also one of the most important topics in the entire CFA curriculum. Level 2 fixed income. We're going to peel back the layers and build a really powerful framework for valuing bonds that goes way beyond the basics you learned in Level 1.
So remember back in Level 1, the world of bonds seemed pretty straightforward, right? You had your yield to maturity, this one single rate that solved everything. But you and I both know the real world is a lot messier. Interest rates are constantly moving, and yes, sometimes companies don't pay you back. Well, Level 2 is where we get the real toolkit to price all that uncertainty.
Here's our game plan. We're going to tackle this in 4 steps. First, we'll go beyond that single yield. Then, we'll figure out how to model rate volatility. After that, we'll use that model to value embedded options, and finally, we'll layer in the risk that the issuer might default. Let's get started. Okay, first up, we have to move beyond thinking about a single yield. It's time to stop using one average rate for everything and start using the right rate for each and every payment a bond makes.
Let's really break down the difference here. The Level 1 YTM is, well, it's kind of like a blunt instrument. It's just a single weighted average for all the cash flows. The Level 2 view, using spot rates, is way more precise. It's like using a surgical scalpel. Each individual cash flow gets its own unique discount rate. And why is this so important? Because this is the only way to get what we call an arbitrage-free price, a value so accurate that it's the true, unshakable fair value.
This leads to a really fundamental shift in how you need to see a bond. It's not one single thing anymore. Instead, think of it as a little bundle of zero-coupon bonds. Every single coupon payment and that final principal payment, each one is its own little mini bond, its own IOU. And each of those little IOUs needs to be valued on its own, using the spot rate that perfectly matches its specific maturity date.
Okay, let's make this real. Look at this 2-year bond. We take that first $60 coupon, which we get in 1 year, and we discount it using the 1-year spot rate of 9%. Then we take the final payment, the $1,060, and we discount that using the 2-year spot rate of 10%. Add them up, and you get the true arbitrage-free price, $931.08. The key insight? The bond's old-school YTM would be 9.97%, an average that doesn't actually price either cash flow correctly.
Now, what's super cool is that spot rates have secrets hidden inside them. If we know the interest rate for a 1-year loan and a 2-year loan today, we can actually figure out what the market is betting the 1-year rate will be starting 1 year from now. That implied future rate is called a forward rate. And this formula right here, yeah, it looks a little scary, but it's the absolute key. All it's saying is that there can't be a free lunch. You have to get the same result whether you invest for 2 years straight at the 2-year spot rate, or you invest for 1 year, then roll that money over for a second year at the forward rate. Both paths have to lead to the same destination. That's what locks everything together. Okay, so now we know how to figure out the market's expected path for interest rates. But here's the thing. Rates never just follow a nice, clean path, do they? They bounce around, they're volatile, so our next big job is to build a model that can actually handle all that bouncing around. The forward rates we just looked at give us the market's best guess, the expected path. But what about all the noise around that path? We need a tool that can give us a map of all the different roads interest rates could take, not just the one main highway.
And that's where this awesome tool comes in, the binomial interest rate tree. Just think of it exactly like a map of possible futures. At any point in time, the interest rate can go one of two ways in the next period. It can go up or it can go down. And how far up or down it can go, well, that's determined by our assumption about volatility. More volatility means wider paths. Now, how we use this tree is, well, it's a little weird. It's called backward induction. And it feels totally backwards because we literally start at the end. At maturity, we know exactly what the bond is worth, par plus the last coupon. Then you take one step back in time. At each point, you calculate the value by taking the average of the two possible future values, add in the coupon, and discounting it back one period. You just keep repeating that step by step by step until you get all the way back to today.
Okay, this is where the binomial tree really starts to shine. It's not just for plain vanilla bonds. Its real power comes from being able to value bonds where the cash flows themselves aren't even certain. Bonds with things like call or put options built right in. So here is the absolute bedrock relationship you have to remember. A callable bond isn't just a bond. It's two things. It's a regular straight bond minus a call option that you, the investor, have sold to the company that issued the bond. You've basically handed the issuer a get-out-of-jail-free card they can use if rates fall. And because you gave them that valuable option, the bond has to be cheaper for you.
This brings us to a super important point. Let's think about this for a second. Put yourself in the issuer's shoes. When are you going to use that option to call the bond back? You're going to do it when interest rates have dropped, right? So you can borrow new money more cheaply. So, how does volatility fit in?
Well, here's the deal. The more volatile rates are, the bigger the chance they could suddenly drop. And if they drop, what does the issuer do? Bam, they call the bond. That makes their option more valuable. And since you're the one who sold them that option, well, a more valuable option for them is a worse deal for you. It lowers the value of your bond. So the big takeaway, if you own a callable bond, higher volatility is your enemy.
So how do we actually value this on our tree? It's the same backward process, but with one simple extra step at every single point. First, you calculate the bond's value just like before.
But then you check, is that value higher than the price the issuer can call it at? If the answer is yes, then you know the issuer would call it, so you have to replace your calculated value with the call price. That simple check and replace rule gets applied all the way back through the tree and perfectly captures the option's value.
All right, we've come a long way. We've handled the yield curve, we've wrestled with volatility, we've even priced options. But there's still one huge elephant in the room risk we've ignored. What if the company just doesn't pay us back?
The good news is, the way we price credit risk is actually super intuitive. You start with what the bond would be worth if it were totally risk-free, like a government bond. Then you just subtract a dollar amount that represents the market's price for the risk of default. And that deduction is called the Credit Valuation Adjustment, or CVA.
So what is this CVA thing, really? Just think of it as the total price tag for the risk of default. For every single year until the bond matures, you calculate an expected loss. You just take the chance they'll default that year, multiply it by how much you'd lose if they do, and that's it. Then you discount all those potential future losses back to today, add them all up, and that total sum is the CVA. It's the fair price cut you should get for taking on credit risk.
And hey, this isn't just some abstract theory. You see this in the real world every single day in the form of credit spreads. That's the extra yield you get for owning a corporate bond instead of a government bond. Look at the table. As the rating goes down, the risk goes up, and investors demand a bigger and bigger spread to compensate them. That spread is basically the market paying you bit by bit for taking on that credit risk.
All right, let's pull it all together and look at the amazing toolkit you've just built. 1. You can now break a bond down into its pieces and use spot rates for precise, arbitrage-free pricing. 2. You can use binomial trees to map out and model interest rate volatility. 3. You can use that tree to value tricky embedded options. And 4. You can calculate the CVA to price in credit risk. You now have a complete 4-part system for analyzing pretty much any bond.
These are the 4 key risks you now know how to dissect, analyze, and price into any bond valuation. And that really leads to the final and maybe most important point. This whole framework, it isn't just about getting a textbook price. It's about finding real-world value. The market is pricing these 4 risks into every single bond every single day. Your job, as an analyst, is to use these tools to ask the big question: where is the market getting it wrong?
So here's a huge question in finance. How do you put a price on the future? I mean, really think about that. How do we figure out a fair price today for a deal that's not going to happen for months or even years? It kind of sounds like you'd need a crystal ball, right? Well, it turns out you don't. In the world of finance, it all boils down to one incredibly powerful idea: no arbitrage. And to really get our heads around this, we need to put on a specific hat. Just like the curriculum says, we're going to learn to think like an arbitrageur. These guys are basically the detectives of the financial markets, sniffing out anything that doesn't add up. By adopting their mindset, we're going to crack this whole pricing puzzle wide open.
Okay, let's dive into the first section. The best way to get this is to imagine it's all a game with a very clear objective, risk-free profit, and as we're about to see, a couple of very, very strict rules.
And here they are, the 2 golden rules of the arbitrage. Rule number 1, you cannot use a single penny of your own money. The whole strategy has to be self-financing. You start with 0. And rule number 2, you cannot take any price risk. It has to be a sure thing. No matter what happens in the market, up, down, sideways, you can't lose. These 2 rules are the bedrock of everything we're about to build. So, you're probably wondering, how on earth can anyone play this game and actually win? Well, our arbitrager has a secret weapon, a fundamental law of the financial universe that lets them price even the most complex future deals without ever having to guess what the future holds. And this is it, the law of one price.
And honestly, it's just common sense. If I have two different portfolios that are both guaranteed to pay you the exact same amount of cash in the future, they have to be worth the same amount today, right? Because if they weren't, well, you've just found yourself a literal money machine.
And check this out. This is exactly what happens when that law gets broken. You've got two portfolios, A and B. Both are guaranteed to pay off $105, no question about it. But look at their prices today. Portfolio B is $1 cheaper. The arbitrager's move is a no-brainer. You sell the expensive one, Portfolio A, for $100, and you immediately use $99 of that cash to buy the cheap one, Portfolio B. And boom! You've just pocketed a risk-free dollar right now with zero money down. The market simply cannot let that exist for long.
All right, so now we've got our rules and our secret weapon. Let's put them to the test. We're going to tackle our first challenge, pricing the most basic derivative out there, a forward contract on an asset that pays no dividends and has no cost to hold it. And here's the answer, believe it or not. That simple little formula tells us everything. The no arbitrage forward price, which we call F0, has to be equal to the future value of the spot price, S0. In other words, you take the price of the asset today and you just compound it forward at the risk-free rate. That's it. We call this the cost of carry model because the forward price is literally just the cost of buying the asset today and carrying it to the delivery date. If the real market price is different from this, our arbitrager jumps in. Now this table shows exactly how they do it. Let's walk through it because this is where the magic happens. Look at time zero. Our arbitrager buys the asset, which is a cash outflow of S0. But at the exact same time, they borrow that exact same amount of money. So what's their net cash flow? Look at the bottom row. It's 0. Rule 1, satisfied. Now let's jump forward to time t, when the contract expires. They sell the asset for whatever its price is, ST. This perfectly offsets the ST they owe on their short forward position. So the variable, the risky part, ST, it just cancels itself out. All price risk is gone. Rule 2 satisfied.
And that's the whole point. The only thing left at the very end is the forward price they locked in, F0, minus the loan they have to repay, which is the future value of S0. So for there to be no free lunch, no risk-free profit, that final number has to be 0. And that forces the market forward price to be exactly equal to the cost of carrying the asset forward. It's beautiful. Okay, so that was the basic model, but the real world's a little messier. What happens when holding the asset isn't free? What if it actually pays you money, like a dividend? Or what if it costs you money, like for storage? Let's add this new twist to the game. So we can group all these extra cash flows into two simple buckets. You've got carry benefits, that's money that lands in your pocket just for holding the asset, think dividends from a stock or coupon payments from a bond, and then you have carry costs, that's money out of your pocket, think storage fees for gold or insurance for a valuable painting. And what's great is that our formula handles this perfectly. The forward price is now just the future value of an adjusted spot price. We start with the spot price as 0, we add the present value of all those costs, and we subtract the present value of all those benefits. Then we just find the future value of that whole package. That's our new no arbitrage forward price.
The intuition here is absolutely key for the exam. Think about it. If holding an asset pays you money, like a dividend, it makes it cheaper to carry it to the future, right? Well, to prevent arbitrage, that benefit has to be passed along, which means a lower forward price. On the flip side, if you have to pay storage costs, that makes holding the asset more expensive. So that cost gets passed on as a higher forward price. It just makes sense.
All right, so far we've nailed down how to price a single transaction in the future. But the real power of this no arbitrage logic is that we can use it to price much more complex instruments. Things like swaps, which are just a whole series of future deals all bundled together.
Now, an interest rate swap sounds pretty intimidating, I know. But at its heart, it's just a deal to trade interest payments. That's it. One person agrees to pay a fixed rate of interest, and the other agrees to pay a floating rate, both on the same imaginary principal amount. They just swap the payments.
And here is the absolute game-changing insight. This is the key that unlocks it all. A swap is not some strange, exotic new creature. It is just a portfolio of the forward contracts that we already know how to price. Each one of those future payment exchanges is like its own little mini forward contract.
So for valuation, this is the way you have to see it. A pay-fixed, receive-floating swap has the exact same cash flows as being short a fixed-rate bond and being long a floating-rate bond. And what does our law of one price say? If the cash flows are identical, the values must be identical. This replication is the key to figuring out what a swap is worth at any point in its life.
And this table proves it. It just lays it all out. If you're long a floating rate bond, you get floating rate cash flows. If you're short a fixed rate bond, you pay out fixed rate cash flows. Now look at the net result in that last row. You get float, you pay fixed. That is a perfect match for the swap's cash flows. And, just as important, look at time zero. You can do this transaction for a net cost of 0, which matches the fact that a new swap is always initiated with a value of 0.
And this brings us right back home. How is that fixed rate on a brand new swap actually set? Well, it's the one special rate that makes the value of that fixed rate bond exactly equal to the value of the floating rate bond at the very beginning. This is what guarantees the whole deal starts with a value of 0 for everyone involved, slamming the door shut on any arbitrage opportunities.
So there you have it. This no arbitrage universe is the absolute foundation for pricing derivatives. For the exam, here are the key takeaways you have to know. 1. The price of a forward is the future value of the spot price, adjusted for the net cost of carry. 2. A swap is nothing more than a portfolio of forwards, and we value it by replicating its cash flows with a long and a short bond position. That's the core of it. And while the real world isn't perfect, this no arbitrage price is the benchmark that everything is measured against. It begs the question, though. If these arbitrageurs are the detectives keeping prices in line, what happens when they miss a clue?
All right. If you're deep into your CFA Level 2 prep, you've probably figured out that commodities, well, they're a whole different animal. So today, we're going to demystify a concept you absolutely have to nail down: the shape of the commodity futures curve. We're talking contango and backwardation and what they really mean for your returns. Let's get right into it. So let's kick things off with a question that really gets to the heart of it all. This is a classic exam-style problem you might see. Why on earth would oil for delivery next year be more expensive than oil you can buy today? Now, you might be thinking, oh, it's just inflation or time value of money, right? Nope. It's way more interesting than that, and figuring out why is the key to this whole topic. Okay, to really answer that question, we have to back up for a second. We need to understand what makes a commodity fundamentally different from, say, a stock or a bond. Because this one core difference, it's the foundation for everything else we're going to talk about. You know, when you think about a stock, what's it all about? Future cash flows, right? Dividends, earnings, that's how you value it. But a barrel of crude oil, it doesn't send you a dividend check. In fact, it's the exact opposite. It actually costs you money just to own it. You gotta store it, you gotta insure it, and all those expenses bundled together, that's what we call the cost of carry. And trust me, that term is gonna be super important. So you have this fundamental split. Financial assets make you money, while physical commodities cost you money to hold. And that, right there, is exactly why you don't see portfolio managers with a warehouse full of oil barrels. It's just not practical. So what do instead? They go to the futures market. So what is a futures contract? At its core, it's just a promise, right? An agreement to buy or sell something later at a set price. But the magic word, the word you really need to remember, is standardized. This means every contract for, say, WTI crude oil is for the exact same stuff, same quantity, same quality, same delivery location. And because of that standardization, you get this huge liquid market where traders can jump in and out of positions super easily, all without ever having to deal with an actual physical barrel of oil. And this market, it's really a tug of war between two main players. First, you've got your hedgers. These are the folks who actually use the commodity. Think about an airline that needs to lock in its price for jet fuel, or an oil driller who wants to guarantee a price for the oil they haven't pumped yet. They're in the market to reduce risk. And then, on the other side, you've got the speculators. They're the risk takers. They're betting on which way the price will go, and by doing that, they're the ones who provide the liquidity and absorb all that risk the hedgers are trying to get rid of. Okay, so when you mix these two groups, the hedgers and the speculators, and you throw in the real-world costs of storing and moving physical stuff, you get two very different, very important market conditions. And for the exam, you have to know both of them, inside and out, what they are, why they happen, and what they mean. Which brings us right back to that first question we asked. Why isn't the future price just today's price, the spot price, plus some interest? Well, because of all this other stuff. You have to factor in storage costs, the risk involved, and how easy it is to get your hands on the commodity right now. And all that creates two totally different shapes for the futures curve. First up, we have contango. This is what you have when the futures price is higher than the current spot price. And the further out you go, the higher the price gets. So, going back to our oil example, if oil today is, say, $70, the 3-month future might be 71, and the 6-month future is 72. That upward sloping price structure, that's contango. So, take a look at this. This is a classic contango curve. Spot price is $75, but if you want to lock in a price for 6 months from now, you got to pay $78. See that? The market is making you pay a premium to buy later. It's a nice, clear, upward slope. All right, now for the flip side. Backwardation. This is the complete opposite. Here, the futures price is lower than the current spot price. You're actually getting a discount to buy it in the future. And what does that tell you? It's screaming that there's a huge premium on having the physical stuff right now. Maybe there's a supply shortage or a spike in demand, but the market is desperate for the commodity today. And here's what that looks like. The curve is totally inverted. The spot price is way up at $80, maybe because of a supply disruption. But look, the market will sell it to you for delivery in 6 months for just $77. That downward slope, that's the telltale sign of a backwardated market. So let's just nail this down because it's the most important takeaway. Contango, futures price is higher than spot, the curve slopes up. Backwardation, futures price is lower than spot, the curve slopes down. You have got to burn that relationship into your brain. It is absolutely fundamental. Okay, so we know what they are, but this is level 2, right? So just knowing the definitions won't cut it. You have to know the economic theories behind why the market gets into these states. And there are 2 big theories you need to have in your back pocket. The first one is called the theory of storage. And really, just think of it like a scale, a balancing act. On one side of the scale, you have all the costs of holding the physical commodity, the storage, the insurance, the financing. All those costs push the futures price up, tilting the scale towards contango. But on the other side of the scale, you have something called the convenience yield. That's the benefit of having the stuff on hand, ready to use, especially when it's scarce. And that convenience yield pushes the futures price down, tilting the scale towards backwardation. The second big idea is the hedging pressure hypothesis. This one's all about those 2 groups we talked about earlier, the hedgers. So think about it. If the producers, the guys selling the commodity, are all rushing to lock in their prices, they're all selling futures contracts. That selling pressure pushes futures prices down, and you get backwardation. But what if it's the consumers, the airlines, the factories who are panicking? They're all buying futures to lock in their costs. That buying pressure pushes futures prices up, and voila, you've got contango. Okay, so we know what these curves are, and I've got a couple of theories for why they happen. But let's be real. As an investor, as a portfolio manager, there's only one question that truly matters. So what? How does this actually affect my bottom line? This is where it all comes together, and you can bet this is a hot topic on the exam.
To get the answer, we have to talk about something totally unique to futures investing. It's called the roll return, or roll yield. See, futures contracts have expiration dates. So if you're an investor and you want to stay in your position for the long haul, you can't just hold one contract forever. You have to sell the one that's about to expire and buy a new one further out in the future. You roll your position. And the profit or loss you make just from doing that, that's the roll return. And this is where the rubber meets the road for investors. Think about a contango market. The contract you're selling is cheaper than the new one you have to buy. So you're forced to sell low and buy high over and over again. That creates a negative roll return. It's like you're constantly running into a headwind that's just eating away at your performance. But now, picture a backwardated market. The expiring contract is more expensive than the new one, so you get to sell high and buy low. That generates a positive roll return, which is like having a powerful tailwind at your back, boosting your returns even if the spot price doesn't move at all. And that leaves us with one final and I think really critical thought. When you invest in commodity futures, your total return isn't just about whether the spot price went up or down. It's actually made of three parts: the spot price change, the interest you earn on your collateral, and that roll return. And that means, and this is so important, you could be totally right about the direction of oil prices and still lose money if you're fighting a nasty headwind from a market in steep contango. So are you betting on the price, or are you betting on the shape of the curve? Understanding that difference, well, that's not just for the exam. That's what separates the pros from the amateurs.
Welcome to the Explainer. So you're tackling CFA Level 2. You already know the game has completely changed. Today, we're not just going to talk about concepts. We are going to build the essential toolkit every modern portfolio manager needs, pulling everything straight from the 2025 curriculum.
Okay, let's just dive right in with the big question, the one that really separates Level 1 from Level 2. Back in Level 1, we learned the basics, risk and return. But at Level 2, you got to go way deeper. It's not enough to just ride the market wave anymore. You have to understand every single current and ripple that drives your performance.
And wow, this slide just lays out the massive leap we have to make. Remember the Level 1 world? So simple, right? Your return was basically driven by one thing, your exposure to the market, your beta. But the Level 2 view? Whoa, it's a whole multi-factor universe. We now see that returns are driven by a whole host of different systematic risks. Things like the size of the companies you invest in, whether they're value or growth stocks, and even their recent momentum. Each one of these is a distinct risk that, historically, investors have been paid to take.
So how do we even begin to navigate this new, much more complex world? Well, that brings us to the very first tool in our modern PM toolkit. We need a way to break down and truly understand these powerful new drivers of return.
And that tool is the multi-factor model. Think of it as our new upgraded GPS. Instead of having just one input, the market, it uses multiple independent risk factors to explain why a stock or a portfolio is doing what it's doing. This is our big upgrade from the simple capital asset pricing model.
Let's make this real with a classic example, the Carhart 4-factor model. It starts with the market risk factor we all know and love, but then it adds three new, really interesting dimensions. First, you've got size, or small minus big, which captures that historical tendency of smaller companies to outperform the big guys. Then there's value, high minus low, which is all about the premium you get from investing in kind of boring but cheap companies over those expensive, flashy growth stocks. And finally, there's momentum, or winners minus losers, which is based on the idea that stocks that have been going up tend to keep going up, at least in the short term.
And this brings us to a huge theme on the exam, so listen up. The crucial mental shift you have to make for level 2 is to see risk as multidimensional. A portfolio manager isn't just picking a beta anymore. No way. They are consciously choosing their exposure to value, to size, to momentum. It's not just about the quantity of your risk. It's about the character of your risk.
Okay, tool number 1 is in the bag. We have a way to understand where our returns are coming from. But now we need a second tool, one that helps us measure a manager's ability to actually generate those returns. How on earth do you quantify skill?
Well, that's where the fundamental law of active management comes in. I know, it sounds super intimidating, but trust me, it's an incredibly powerful and honestly pretty intuitive framework. It basically gives us a mathematical formula that connects a manager's forecasting skill, the number of chances they have to use that skill, and the quality of their results. And we measure those results with something called the information ratio.
And here's the best way to think about it boiled right down to its core. Your result, your risk-adjusted active return, is basically your forecasting accuracy multiplied by the square root of your opportunities. It's so elegant, right? It shows you can win in 2 different ways, either by being incredibly accurate with just a few big bets, or by being just a little bit better than average across a huge number of bets.
Let's break that down piece by piece. First up is the information coefficient, the IC. This is a pure measure of your skill. It's just the correlation between what you predicted would happen and what actually happened. Next is breadth, or BR. That's simply the number of independent bets you're making. And when you put them together, you get the information ratio, or IR, which is really the holy grail of active management, right? It's your active return per unit of active risk.
Okay, this table really brings the whole thing to life. Just look at Manager A. This is your classic sector specialist. Super high skill, right? An IC of 0.15. But they only make, say, 9 independent decisions all year. That gives them an information ratio of 0.45. Now, check out Manager B. This is more of a quant manager. Their skill on any single decision is way lower, just an IC of 0.05. But they make 100 independent decisions. And look at that. Their IR is actually higher at 0.50. It just goes to show you there's more than one way to win this game.
And hey, here is a classic exam trap you absolutely need to avoid. Do not mix up the information ratio and the Sharpe ratio. The Sharpe ratio looks at the entire portfolio, its total return over the risk-free rate divided by its total risk. The information ratio, on the other hand, is laser-focused on just the active slice of the portfolio. It's all about measuring the consistency of your outperformance against a benchmark. All right, so we've got a tool to understand returns and a tool to measure skill. That brings us to our third and final tool, the one that helps us manage risk and answer that one question every client eventually asks, just how bad can it get? And that's where value at risk, or VAR, comes into play. Now, this definition right here from the curriculum, every single word matters. Notice the key phrases. It's the minimum loss for a certain percentage of the time over a certain period. It is a statement about probabilities, not some guarantee about the absolute worst thing that can happen.
So what does a number like this actually mean in the real world? Well, if your portfolio has a 5% daily VAR of negative 2.2 million euros, it means that on any given trading day, there's a 5% chance your portfolio is going to lose at least 2.2 million euros. To put it another way, think about the worst 1 out of every 20 trading days. On those days, we expect our losses to start at this number, and they could definitely get much, much worse.
Okay, this is probably the most tested point on VAR, so burn this into your brain. Value at risk is not the maximum possible loss. It's a floor, not a ceiling. It answers the question, how bad might it get on a normal bad day? It does not answer the question, what's the absolute most I could possibly lose? Because, of course, that answer is always everything.
And one last thing on VAR that is super important to remember, it's not some magic number that's always right. Look at this chart. The method you choose to calculate it, whether you use a simple parametric model, or you run a historical simulation, or you do a complex Monte Carlo simulation, is going to give you a different answer. VAR is an estimate, and the assumptions you make to get that estimate matter a lot.
All right, so we've unboxed our 3 essential tools. Let's lay them all out on the workbench and see what we've built, see what this complete toolkit for the modern portfolio manager really looks like.
And here it is. It's this beautiful, logical process, right? You use factor models to truly understand the real drivers behind your portfolio's performance. Then you use the fundamental law of active management to measure and quantify your skill at generating that performance. And finally, use value at risk to control and manage your downside risk. Understand, measure, control.
And that leaves us with the big question, doesn't it? The CFA curriculum gives you this incredibly powerful set of tools. But at the end of the day, tools are only as good as the person using them. The models, the formulas, they provide the numbers. But the real challenge, the art of great portfolio management, is applying the wisdom and the judgment to use those tools effectively.
All right, CFA Level 2 candidates, welcome. We're going to jump right into the one topic that can literally make or break your exam: ethics and professional standards. Look, it's not just about the heavy weighting on the exam. It's a total gatekeeper. You absolutely have to master this stuff, so let's make sure we get it right. So here's what we're going to cover. First, we'll hit the big picture: why ethics is the foundation of our markets. Then we'll get into your professional toolkit. After that, we're going to apply the rules to some real-world situations, break down the kind of traps you'll see on the exam, and we'll wrap up by talking about the ethical compass you really need to develop to pass this thing and, succeed in your career. Okay, first up, let's just set the stage a little. You've got to understand, ethics isn't just another chapter you need to memorize for the exam. Nope. It is the absolute bedrock of the entire financial industry, period. This quote right here from the curriculum, it's not just there to sound dramatic. It's a serious warning. Every single one of these scandals, Ponzi schemes, insider trading, they all attack the one thing our markets cannot survive without: trust. And believe me, when that trust is gone, capital vanishes, markets grind to a halt, and the whole system just falls apart. So what are we really talking about with ethics? At its core, it's all about balancing what you want, your self-interest, with how your actions affect other people. And when you're managing someone's life savings, well, that's not some abstract idea from a textbook. That is the job. It's your number one responsibility. Okay, so how do we navigate all these challenges? Well, the CFA Institute gives us a very specific framework. Think of it as your professional toolkit, and it's made up of 2 key parts: the Code of Ethics and the 7 Standards of Professional Conduct. These 7 standards, they are the foundation for every decision you'll make. Now, remember back in Level 1, your job was basically to identify them. But here's the big jump to Level 2. It's all about application. You have got to know how to use these rules in messy, complex, real-world scenarios, not just recite them from a list. All right, let's see how this actually works. We're going to dive deep into 2 standards that are absolutely critical. And trust me, these get tested all the time because they protect the very heart of what we do: our clients and the integrity of the markets themselves. Now, at first glance, this one seems pretty straightforward, right? Don't trade on inside info. But it's the details, the nuances that trip candidates up on the exam. So what does material mean? It means the information is significant enough to affect a stock's price or change an investor's mind. And non-public? Well, that's simple. It's not public until it's been properly shared with the entire market. Let's look at a case. Okay. Pay close attention to how the violation just cascades down the line here. The info is obviously material and non-public. So Staple, he violates Standard 2A the second he opens his mouth to his broker. Then Halsey, the broker, violates it all over again by actually trading on that tip. The exam loves to test this chain of liability. The key takeaway, they're both on the hook.
So this brings up a great question. How can an analyst ever get an edge? How can you develop a unique insight without breaking the law? The answer is something called the mosaic theory. This is a huge concept for level 2, so really dial in. Think of it as your safe harbor. It's what allows you to piece together bits of public information with bits of non-material, non-public information to create your own unique and material conclusion. And this right here, this shows you the bright line difference perfectly. The mosaic theory is all about doing your homework. It's diligent research, you're talking to suppliers, analyzing filings, visiting stores. You are connecting the dots yourself. Insider trading, that's when someone just hands you one big material, non-public dot. Totally different.
All right, let's switch gears a bit. You know what the exam absolutely loves to test? Your ability to handle conflicting duties, especially when you've got different laws and the professional standards all pulling you in different directions. So let's break down a couple of scenarios you are almost guaranteed to see. This is a classic exam trap, so listen up. When you're working across different countries with different laws, the rule is actually pretty simple. You always follow the strictest rule, period. I like to call it the high watermark principle. If the local law is tougher than the code, you follow the local law. But if the CFA code and standards are stricter, you follow them. You are always held to the highest ethical standard. Okay, let's put you in the manager's chair for a second. Imagine you get a tip, a credible one, that someone on your team might be front-running client trades. What do you do? Specifically, what does standard IVC, your responsibilities as a supervisor, demand that you do right now? So you can't just pull the person aside for a quiet chat and tell them to knock it off. No way. The standard requires you to act promptly. That means you've got to start an investigation. You need to contain the potential damage, which might mean ramping up supervision or even putting limits on their trading while you figure things out. And this is critical. You have to go back and review your firm's own procedures to figure out how this could have happened in the first place, and then fix it so it doesn't happen again. All right, let's really put this to the test with a couple exam-style questions, the vignette format. This is where the rubber meets the road, where you have to apply the code when you're under pressure. Okay, read this one carefully and think through your standards. You've got a CEO, and her husband's family owns a majority stake in a company that her firm is recommending to clients. But that little detail isn't disclosed anywhere in the research report. So what do you think? Violation or no violation? Yep, it's a slam dunk violation of standard VA, which is all about conflicts of interest. Here's a pro tip for the exam and for your career. The answer to almost any conflict of interest is disclosure, disclosure, disclosure. Look, telling clients about the family connection doesn't automatically mean the research is bad. What it does is give clients the info they need to decide for themselves if the recommendation is objective. Hiding it, that's the violation. All right, here's another one, a very common trap. You have this informal deal. It's not cash changing hands, just, some nice dinners, maybe some sports tickets for referring clients. So since it's not a formal cash payment, is it okay to not tell the clients about it? No, it's absolutely a violation. This hits standard VC referral fees head on. And the standard couldn't be clearer. Any kind of compensation or benefit, whether it's cash, tickets, the fancy dinner, whatever, it has to be disclosed. And not just disclosed at some point, but disclosed to the client before they agree to anything. The client has every right to know who's getting a benefit for that referral. So we've walked through the rules, we've seen how they play out in different scenarios. But, the real goal here isn't just to turn you into a walking, talking textbook. The ultimate goal is to help you develop your own solid professional judgment. And this is probably the most important thing I can tell you. You've got to shift your whole mindset for level 2 ethics. It's not about being able to just spit back what standard 2A says. It's about really understanding the why behind the standard. Because when you internalize that why, you can use the framework to navigate all the tough, gray areas you're going to face, not just on the exam, but for your entire career. Because in the end, that's the real question, isn't it? When the rules aren't black and white, what's going to be your guide? The code and standards, they give you the map, but you're the one who has to navigate. Remember that. Carry that responsibility with you when you walk into that exam, and definitely carry it with you into your career. Good luck.